Hold that transmit order button. This is Steve from Digreshka.com. Let me share to you our very own pre-trading checklist in making our short option trades. First and foremost, before we engage in selling positions, we have to ask ourselves, is implied volatility or IV relatively high? Our business in selling options is mainly a business of margins. If IV is high, we increase our premium collections to answer for the losses that we eventually need to take. It's helpful to use IV rank or IV percentile to gauge if IV is relatively high or low. The best way to determine whether a stock is trading on a high IV environment is determining its relative IV. And we already put up a separate lecture for this for you on a separate video. All you need to do is to click on the first link on our document after watching this video. For now, it's helpful for you to know that IV rank provides a great gauge of whether an underlying is trading in its own high IV environment or not. Remember, once we open a position, we generally do not want IV to go higher, since this makes our buyback or closeout value more expensive for us. Once we open a position, we generally want IV to more or less start going down the moment we open the position to reduce our buyback value. And then we go to the second point. Is the current implied volatility high enough to exceed the current historical volatility? Options generally are overpriced through IV, yet we should make sure that in fact they are, as we avoid actual market movement to get our strategy in the money. Actual volatility should be less than implied volatility. This can be gauged by comparing IV and HV indicators or charts. Third point on our list, are there any undefined events that can increase implied volatility during the period in which the trade is held right after we sell the options? We certainly cannot see the markets through a crystal ball, but once we know of a potential merger or upcoming earnings and other significant events that can increase IV, it's safe to generally steer clear of selling options, especially the ones that do not pay so much more for the added risk you are taking. Next on our list is a margin requirement or the risk not dangerous to my portfolio? Avoid trashing your account. Think, is your max risk in this one trade 1 to 5% of the total portfolio? If not, you are putting your account on risk. And if you're not convinced by our max 5% max risk rule, please see our link video lesson on LLN, law of large numbers, and trade sizing and management. Just right after you watch these two videos, you will know exactly why we do not recommend risking more than 5% for any single trade. Flexibility to trade. Will we still have sufficient capital and power to handle possible losses after this trade? As a net seller, at least 40 to 50% of the portfolio in cash or liquid funds is not a bad sum to be able to adjust trades. This will give you enough allowance in case the general IV and the general market condition in a worst case scenario goes against you. Strike level. Are the strikes selected in such a way that the position can be rolled into a new expiration date without taking additional risks if possible? Is it a position that you would believe in that you can eventually roll if it approaches expiry and begins to be challenged? Company performance, price, and industry standing counts in picking which strike you will sell. Liquidity to transact. If it's not liquid, you are risking to engage in transactions with bigger spreads. This goes independently into consideration for option chains of the underlying and the various individual strikes in the option chain. Options of a particular underlying might be liquid, but not all strikes are widely traded. Generally, you will notice as you go deeper out of the money or deeper into the money, the spreads are wider, and often those strikes are not actively traded. Assumptions on the market direction of the underlying. Have I made assumptions regarding the market direction of the underlying? Is it bullish, bearish, neutral? If we are bullish, we open a put credit spread. If we are bearish, we open at least a call credit spread. If we're neutral, we open an iron condor. Is the overall market assumption of the trade we are to make compatible to our market outlook? And last but not the least, is there still enough time to trade the option? Depending on your system and strategy, before selling an option or an option combo, you have to see if there's sufficient time for the trade to work. So this is our very own comprehensive checklist before entering short positions on options. We use this as a guide before every short option trade we make. It has worked well so far for us, and we hope that it adds value to your trading.